Hello, everyone, and welcome back to what was supposed to be, I don't know, a breakfast show or something else. We are back now for the close of the market. We have Micron and Dlocal that would report their quarterly figures in about 14 minutes, and then the earnings call is probably going to be 1 hour after the close. I am probably going to be joined by Manuel, depending on if he wants to join or not. He will be joining in 2 minutes. So we have some things to talk about. There is a lot of red in the market. I think we had a hotter than expected inflation report. We didn't get a rate cut, which, okay, I guess that remains unchanged. So a lot of red in the market. If we go and look at the heat map right now, also, by the way, welcome everyone. Hello, hello. This is basically what we have at the moment. Red across the board. We do have here AMD, that's green, Intel, that's green, Arista Networks, that's green as well. So some of the names are green. If we go and look at our nice little list here, Rocket Lab is down 11%, BMNR down 7%, HIMS down 6%. What is actually green today? Okay, Core and Nebius are still green. Micron is green, Rubrik is green a little bit, Oscar as well, but that's about it. If we go and look at the fintech names, all of them are red. Okay, cool. Not that cool, but still, Nebius and Corif are the ones green. That's very good. As for semiconductor names, we do have a couple of names that are green. And crypto, okay, still holding above 70,000 for Bitcoin, 2,100 for ETH, so that's fine. I completely, honestly, this week has been very hectic. Completely forgot we had Jerome talk today. I don't know what he said. Probably nothing that great if the market is acting the way it is. But then again, I don't know why people are surprised by the fact that we are not getting any rate cuts right now. Maybe it's because we actually let me pull this one up. We're going to go over some of the comments here. So, data center build-out probably is pushing inflation up. AI investment probably boosts a neutral rate in the near term. I would reserve the term stagflation for, a much more serious set of circumstances. Okay. Vast majority of participants don't see hike as a base case, but we don't take things off the table. Okay, I also don't think we are going to see any hike anytime soon. Let me pull up our guest for today. Manuel, how are you?
Hey, man. Is my mic okay?
Your mic is, yeah, I guess it is okay. Yeah.
Because it's been a while since the last time I did something.
No, it's perfect, actually. Okay,
How are you,
so
my
no
friend?
rate cuts. Good. Hectic week. Lots of movements. You want to say something? He's taking a break. Okay. So yeah, we have Dlocal, we have Micron. I'm still expecting a lot of growth from Micron to be reported. Dlocal, based on last time we got some guidance, we should be okay. He's coming back in a bit. We should be fine unless something drastically changes in the markets that they're in. Although I would say maybe some of the markets can be impacted right now, which could impact the forward guidance that we're going to get. That's definitely a possibility. That's always the risk when you are a small company in a big market, and especially a market like emerging markets. Certain events can definitely impact your business going forward. You want to test something?
No, it's perfect. Sorry.
Okay. No problem.
It was perfect, but I had to change the Wi-Fi because I was like listening you, but freezing all the time.
Okay, perfect. So, any expectations, thoughts for Dlocal tonight?
I mean, it's always hard to guess the quarterly results of Dlocal because of the impact of so many currencies, and like in some countries you may have a one-off event or whatever. So regarding Q4 itself, I'm not expecting something in particular. Like I'm open. Obviously, I'm confident as a shareholder, but like I haven't thought about a specific number or expectation. But I guess guidance should be good because in the last interview that Pedro gave, he said that he expected TPV to continue to grow more or less at the same pace as in 2025, and that's, I mean, assuming it's not, assuming it doesn't need a huge decrease in take rate for that to happen, then it means estimates are quite low. What analysts are expecting in terms of revenue and EBITDA should be lower than what they're going to say. But I mean, they can always issue a sandbag guidance. I mean, the uncertainty right now is quite high. We've seen a lot of companies doing the same. They might like issue a guidance with like the lower range as more or less what the analysts are estimating, even if think they're going to achieve much higher, and then give some room to increase in the upcoming quarters as they've done in the past year. So yeah, I'm confident, but we always know that with the locals, sometimes we have a great quarter and it goes down like 20%. So in terms of stock price itself, I'm quite grounded in terms of expectations.
Yeah, I mean, the reaction of the stock, whether it's up or down, it has always been like a huge move. It's either up 20, 30%
Yeah, the
or down
implied move is
20,
always crazy.
30%. It's insane. Um, I do wonder because if we do get TPV growth of again above 50% and somehow margins, let's say, remain flat or maybe even improve a little bit, which I think is the best case scenario. I mean, this thing, we see the same reaction with the stock that we've seen 6 months ago, which I think went up 30% in one day.
Yeah.
Even if margins are flat, I think the stock should react positively as well. Because now the fears is always, okay, you can grow fast, but when will margins bottom? And I think if they can show that margins are, let's say, bottoming, staying flat while they still grow this quickly, should be something good. But then again, we don't know if they are getting impacted from one-time events in certain markets regarding currencies and things like that. It happened before with Egypt, I believe. So might happen again. We'll have to see. But I I don't see how the business does not do well. That's the thing.
Yeah, exactly. I'm sure the thesis will stay on track, but in terms of this quarter itself, it's always a bit unpredictable.
Yeah. Any news on Rocket Lab for today? I just got back home, saw it's down 11%. Is it just the usual Rocket Lab was up yesterday a lot, or
No,
so
no.
today it's down, or
Yesterday they opened an ATM program of $1 billion.
okay? So yesterday was a day where a lot of our well, not a lot, Nebius.
Yeah, yeah, yeah. But I mean, to be honest, this is probably not mostly, but partially because of how red the market is today. Because at current prices, $1 billion is like 2.5% dilution or something like that. I mean, they can really put that money working in a very efficient way, as Peter Beck has shown. So 2.5 to 3% dilution, even if the stock goes down and they use it lower, like 4% dilution, it's going down by what, like 10 to 11%, something like that.
Yeah.
So it seems too much. But yesterday they went up 10% without any news as well. So
Yes.
I mean, we can't really complain.
Any thoughts on Nebius, the Meta deal, then the new, let's say, partnership with Nvidia, the new partnership with CrowdStrike, and then of course the $4 billion right now.
I think it's business as usual for them. Like the thesis is very much on track. The Meta deal, we were like most people were expecting it to be upsized. We knew it was because of demand, and we knew from CoreWeave management that contracts are now being signed like 12 months ahead of infrastructure being deployed. We also knew from the beginning that Nvidia is a very big partner, and it has always been. Yandex was the company outside of Europe and the US that had the longest and most expensive relationship in the world. Not even companies in China were larger. So the investments, I wasn't really counting on it, but I thought it could be really possible because, I mean, $2 billion for Nvidia is nothing, and they're throwing checks to so many companies that aren't uh, as strategic as Nebius is for them. That it sounds like a good fit and something that they could do at some point. So it wasn't surprising, but at the same time, I wasn't counting on the timing, let's say. But the dilution, I mean, it's part of the thesis. I My last valuation model was after Q3, so I still need to update based on the last earnings and on everything that has been happening. But even on that day, I used the 30% dilution after the number of December 2025. So I think they closed the year with 253 million shares outstanding, and I used like 324, something like that, like around 30% higher. So more than the Nvidia stake, more than the convertible notes, and I still have some room for SBC or if they want to use a bit of the ATM. So the dilution has always been part of the thesis. Everything that happened is just validation of what we already knew as shareholders. The Meta deal, the Nvidia investment, the partnerships, the partnership with CrowdStrike. I really love to see it because security is increasingly a very important part of AI cloud. And to get a really full stack approach, you might have your own security, but if you have the best in the world or the name that everyone knows, it's always a plus as well. So it's continuation of the expansion of the platform's capabilities, like with the acquisition of Tavili and so on. So I think it's just they're executing like they've always been. They don't want to just issue press release out of nowhere. We already know that when they have something good to announce or bad, whatever, they announce it. They're just cooking behind the scenes, and I've been a happy shareholder with that, honestly.
I agree. I feel also when we get Nebius announcements, it's always like puzzle pieces. It's like we had the Meta announcement, so then we know that probably we're going to see a raise happen pretty soon. Then we have the yesterday's also the sort of a partnership with Nvidia to make sure that we have more of these small AI startups, etc., come into the Nebius ecosystem. It makes sense. But in order for that to make sense, you have to have security. So you get the CrowdStrike deal. So every news that comes out, it's another piece of the huge puzzle that is Nebius, and it makes so much sense. They're just moving in the right direction, executing like crazy. And of course, we know building data centers, buying GPUs, it's not cheap. So if they can get prepayments, commitments, etc., from the big guys, I mean, what is it now? $47 billion in contract commitments. I think if we combine both,
like
it's amazing for them. It's amazing to go to lenders, you name it, and say, look, this is what we have, and it's not from small people. It's an investment from Nvidia, commitments from Meta, commitments from Microsoft. It makes their life much easier and probably cheaper as well. Which, okay, dilution is never great, but if we see the long-term potential here, it's going to be huge. And the markets are closed right now, ladies and gents. Seems like most of the names were completely red. Dlocal results and Micron results are going to be released probably soon. Earnings call is probably in an hour or so, I think, right? For Dlocal, they do it
in
an hour. Yeah. So we will have time to look at all the numbers for Dlocal, and let me actually put this up, and Micron as well. We'll see who moves. DLO. So in 4 minutes. Okay. So we still have a couple of minutes. I see you've opened a new position in a company, very small company. What's that about?
Yeah, it's a company that one of my subscribers recommended me to take a look. And honestly, when I had a surface level look, I thought what everyone thinks. I didn't really, especially since I'm always getting suggestions of stocks to check. I was like, okay. I spent like 5 minutes looking at it and I discarded it right away. Then everything that he said was going to happen, my subscriber, it started to happen, and the stock continued to perform very well, and they reached some milestones that were really an inflection point in the thesis. And he was quite clear explaining me and like giving me resources to understand the thesis in a quick way. And I thought it's really a great opportunity. Back like before I started to write things on X or whatever, like 5 years ago or something. Or maybe four. I can't remember for sure, but I was always trying to find a micro cap. Like I didn't want $1 billion companies. I didn't want $2 billion companies, three, four, whatever. I was always trying to find micro caps. But then I realized that at the time I didn't have the the necessary time and commitment to do it, and because micro caps don't really require more research, but at least require a lot of research. And I wasn't like I am right now doing it every day and so on. So I stopped and went to other ventures. But this is just to say that I've never, or for these years, I've never found a microcap that I thought was de-risked to some degree and with an asymmetric upside as well. And so I was really interested in the thesis, and I was able to talk a bit with the CEO. I mean, just a few questions because he can't really say much because it's in the quiet period, and tomorrow they have earnings. But in terms of, I always like to, my readers know that I always like to start the thesis with the origins and like how the company started, what was the goal, if they pivoted along the way, like what really happened until today. And as this is a micro cap, I wasn't really being able to find much information on that aspect. And when I when I had my conversation with the CEO, I even touched on some points that I found like on ChatGPT or Gemini or wherever, and they were totally wrong. Like they were saying the company was founded in 1980s and it was in 2011 or 12. So it was a good conversation just to not only to meet him and to know the guy himself, because I've had bad experiences with management teams from microcaps. So I wanted to know his approach as well, and I found him like a really dedicated guy, not one of those that tries to pump the stock just because. And the thesis made sense to me. That's why it's been a while, and I was a bit afraid of starting a position in a microcap because of like having a huge following base, and I don't want to move stocks at all. I really don't feel comfortable when I talk about a stock and it moves. I mean, I don't, nothing against those who do it, or maybe something, but it's not something that I want to do. But fortunately, it didn't even move when I announced it.
Okay, fair enough. And in short, what do they do?
They have the only treatment for stomach pain in children. It's like a device that you put in your ear and you do the
Okay.
treatment for like 4 weeks, and then it helps a lot. And there are like some children that can't really live their lives well because of this and have no solution. And the inflection point was about reimbursement. Starting in January, they got the CPT-1 category code, which is really a big deal in this type of pharmas, and they're going to now ramp up revenues like crazy. And now it's the early part. I could have catched it like at half the price when my subscriber told me, but I didn't pay attention. But now it's more de-risked, so.
Okay, fair enough. And if everyone's interested, can go follow Manuel on X and on his Substack, where he has all the information for you. In the meantime, we do have Micron's earnings that came out, beats across the board, adjusted revenue up 196% year over year, $23.86 billion. Analysts were expecting 19.74. EPS $12.20. That's adjusted. Expectations were $8.90. That's up 682% year over year. Gross margins was a huge beat. Operating margin was a huge beat. Operating cash flow was a huge beat. $11.9 billion. Crazy quarter. Even the guide was a beat. They expect EPS of $19.15 plus minus 40 cents. The estimated number was just 11.7. So it's quite a big disconnect there. Adjusted revenue of $33.5 billion. Expected number was 22.5. So an $11 billion beat, which is also insane. Adjusted gross margin of around 81%. So insane numbers. And this reminds me of NVIDIA early on when they were already starting to grow quite quickly, but then the analysts every single quarter, they were just so far from the actual numbers. Like, how can you be $11 billion short in an estimate? It's quite something.
Somehow the market's already priced that in because it's red, right?
Because it's basically flat 0.3% right now. But when was it? 10 days ago, the stock was at $370, and now going into the report, we're already at $460, which is also completely missed that run. But yeah, year to date, it's still up 46%. Yeah. It's at all-time high. So yeah, maybe you could say it's priced in, but then again, if you're looking at the numbers that the market was expecting, maybe not enough of it was priced in.
I don't think it was. It was a huge report. I was just looking at your comments on the live.
Yeah.
They were like,
"Well, this is crazy." Like you go,
these giant companies are posting numbers just insane. It's like this is like a few $1 million.
Yeah, for real. Like this is literally as if a small company were to report like a small beat of $2 million. This is like a beat of a couple of billions of dollars. This is insane. Plus, you also get a little dividend for those that are interested in that. But yeah, cloud memory business unit.
We should also know something about Dlocal's dividend.
Yes. Yeah. 30%, right?
Call me a dividend investor.
Yeah. I do wonder if it's going to be quarterly or not, because we don't even know that.
Yeah. I just remember this like for the first time.
Yeah. But the last time we got a dividend payout was like the special one was also a very nice present.
Quite good, man.
Yeah.
I was not expecting it.
Let's see.
No results so far?
No. Probably maybe 15 minutes after or 30. It's either or. But yeah, Micron is just, I don't know what SK Hynix is doing right now, although we'll probably find out tomorrow. But yeah, Micron, insane. Cloud memory business growing like crazy. Margins are expanding. Core data center business, same story there. Even automotive is up substantially. Gross margin 68%, operating 62%. Crazy stuff. But of course, as we all know, they reported on the wrong day. They report on the day where things are red. When we've had the FOMC meeting, we probably had a little hotter than expected inflation report. But don't forget,
PPI
guys,
data with stuff.
Yeah. Plus the fact that it's up 46% year to date, I guess it plays a part. Although when you look at these numbers, it could continue to go even higher. It's up 1.5% right now, so it's fluctuating quite a lot. We'll see. They'll probably tell us a little bit more during the earnings call if they are sold out, if they're not sold out. What about pricing? Based on the comments everybody else gave us, it seems like prices are expected to go up, and so it should benefit Micron, Samsung, and SK Hynix. But we see here, what is it? Here we have a 30% increase in their dividend. So Micron growth investors, we are getting even a nice little bump here in dividend payouts. Who knew that growth investors turn
Yeah,
into
this is like a
dividend collectors?
dividend live stream. This.
I mean, I own Meta, I own Google. They also are paying dividends. So sooner or later, the whole portfolio is going to pay me a dividend, which is crazy. But yeah, well, these numbers are. I was expecting good numbers, but these numbers are just incredible stuff. Still nothing on Dlocal though. Still
No,
nothing. Don't
I'm
remember what.
refreshing like constantly.
Yeah, I don't know what we did last time. If it was 15 minutes or if it was 30 minutes after the close.
No, I think it was 15.
Okay, so we still have three minutes until that one. But yeah, Micron seems to be flat at the moment. Huge swings here. Nothing really that
Any
special.
other company that reported? Interesting.
Today, yeah, I do think that there was one extra. Let me check the earnings calendar. There is, I don't really follow it, but there is like Red Cat.
I think results should be in because we're green 4%, 6%.
Ooh.
It's pumping, so probably.
I have one big green candle.
I don't know if it has much volume though. No, I don't think it has much volume, but it should be out.
Yeah, I hope it's out because I think I've seen this. I had the PTSD of seeing green candles and then suddenly, bam, erased. Let me check.
Yeah, I don't think it has much volume. It has okay, now it's up 10%. Please don't fade me.
Yeah.
Please don't play with my heart. But yeah, it still has like very low volume, so it could completely reverse. And I mean, no results, so maybe someone is just playing with the stock.
Yeah, but this is the worst because then you know it's coming down.
Yeah. They're going to break our hearts.
Let's see. Still, I don't see anyone posting the
10K
numbers.
volume, so now I'm not optimistic. Dlocal is out. Someone is saying in your
Dlocal is out.
comments.
Okay, let me hard refresh their page.
Yeah, it's out.
Yeah, it's out. Perfect.
$300 million buyback. $57 million dividend. TPV up 70%.
Okay, let me see if we have a table somewhere. Okay.
So what the? This is crazy. Revenue up 65%.
TPV is up 70%. What the heck is this?
Bro, this is insane.
Yeah. Okay. Margins are down 7 percentage points year over year, but quarter over quarter, was that the same or not? But again, if we're getting 70% TPV growth, 65% revenue growth, I guess we should listen to Pedro and agree that growing TPV way more than gross profit margin coming down makes sense for them. Adjusted EBITDA over gross profit is still 68%, so that's good. Net income is up 87%. Net income margin is up 60. Is at 16%.
Can you scroll down a bit just to
the guidance or something else?
Yeah. I was just trying to see the TPV guidance.
For 2026, it's over 50%.
Yeah.
Again.
So Pedro wasn't kidding.
Wow, that's crazy. Over 50%. Gross profit 22.5, 27.5. Operating profit.
Okay.
A bit high.
This gross profit.
Do you have on your side the last quarter's number so we can see if quarter over quarter things have come
One
down.
second. Let me just make that usual post with the numbers. Yeah, we need to also check what those estimates of guidance mean because they only say the growth, right?
Yeah. Yeah, they only say the growth, but they give us here what 2025 was, so it makes it a little bit easier. So basically adds almost over $20 billion in TPV. A little bit over it.
So no revenue guidance?
No revenue guidance here. No.
Interesting.
Yeah, might maybe give us something during the call, but for now, no revenue guidance. I find something. So the dividend, they're not saying it's going to be a quarterly thing. They just say that it's going to be paid on June 10th, and that's about it.
June 10th?
Yeah, to be paid on June 10th, you will.
It's holiday in Portugal.
Perfect.
So I'll get some beers from Dlocal.
A lot.
Yeah, like a
$300
truck
million.
of beers.
$300 million in share repurchases at the current market cap with the amount of shares outstanding is going to be interesting how they're going to do this, because previously they said they want to do a dividend and not share buybacks because of the liquidity issue. So
yeah, but I think what that offering they made, which was a non-dilutive thing.
When was that exactly?
I need to come back to that. But you remember when they did a sort of offering, but like not offering like a tender offer, I think, from an institutional investor. Let me check.
Yeah.
I think that freed some liquidity, so maybe that's why. Not sure. I still need to check because it was a few months ago.
Okay. Wow, that growth rate was crazy.
How's the stock right now? Plus 8%. I mean, after all the fintech meltdowns, this is pretty good.
Let's see. Stock is still up 8% for now. I think implied move was a bit more than that, but we still have time. Still have time to go up more or go down depending on the mood. Let's see. Feels good.
I'm relieved after this terrible day.
And by the way, it's for the SoFi people in the chat and listening. Don't forget that Muddy Waters was also going after Dlocal a couple of years ago, and that led to absolutely nothing.
I mean, the stock suffered a lot, but
the stock suffered a lot, but there was no truth behind the claims. So it was 37% gross profit margin last quarter, and now 34%. So it's down 3 percentage points, quarter over quarter. Probably because something that they mentioned here. So strong seasonal e-commerce growth in Brazil, supported by solid trend across streaming, advertising, financial services, and remittances. I think it's every quarter almost the same. Partial recovery in Egypt. So, okay, that was the hit from last quarter, which already gave us some hints that things are getting a little bit better there, reflecting the return of a large merchant and ramp up of a new e-commerce, streaming, and ride-hailing merchants. Okay. Strong volume growth in Mexico across e-commerce, on-demand delivery, and ride-hailing, and broad-based growth in other Africa and Asia, with notable South Africa contributions. These results were partially offset by Argentina, given higher cost amid election-related FX and rate volatility. in constant currency, gross profit growth for the period would have been 34% year over year instead of 38. Okay. As a result, gross profit margin was 34%.
Yeah, there's always something.
Yeah. Gross profit over TPV was at 0.88%, decreasing from 1.09 fourth quarter 2024 and 0.99 compared to the third quarter, reflecting their strong TPV momentum and natural margin pressure dynamic of scaling volume. So again, the same, basically what they've been saying for the last couple of quarters. TPV is going to grow much, much faster than take rate is going to slow down or come down, I should say, which again is exactly what's been happening. The question is going to be whether the market cares about it. Because okay, fine, the market wants to see growth and margins go up. But then again, if I can get 70% year over year growth and the margins are coming down a little bit, I'm going to be happy with that.
Yeah,
and Certici, thank you for becoming a member. Really appreciate that. I do wonder why we didn't get the, where is it?
Oh, we have a new slide.
There are slides. Great.
Yeah. We have a new slide comparing the operating profit plus DNA divided by gross profit margin, comparing with Shift4, Adyen, PayPal, Mercado Libre, Shopify. Like just talking about how efficient the business is in terms of
what slides?
Leverage. 14. There are a lot of new slides actually, and the layout.
48 slides.
Yeah.
Okay.
Quite nice, the presentation actually. They have.
I own Shift4 as well, so seeing it at number 2 here is pretty good also.
Yeah, especially when you look at the valuation.
Yeah. Interesting. Gross profit per employee. Okay, I like that they're adding things that the market was going to ask them in a negative way, and they're like, look, if we look at these types of metrics, for example, here, gross profit per employee, it starts to recover, and actually it's at all-time highs right now. This is good investor relations. Is if the market has doubts, don't remove slides, add new ones with more information.
I was looking at the dividend. It's 19.39 cents per share.
Yeah.
So at $12, it's like 1.60 dividend yield.
I think I can buy a couple of extra Dlocal shares with their dividend.
Exactly. Increasing the position by 1.6%.
Yeah. But it's probably, what do you think? It's just going to be a semi-annual or just a special dividend, and they'll decide?
I understood the same as you. It looks like an annual dividend.
Yeah, because if it makes sense, especially since they now are going to do a $300 million share buyback. Because otherwise, I think they would have done quarterly dividends.
I'm wondering if this affects their acquisition of Asa Finance. But Pedro recently said that it was going to happen. So maybe they pay with shares or something. I mean, they have, how much cash they have right now? They should be pretty solid in terms of cash. Yeah, they generated like almost $200 million in cash during the year.
So cash yeah, that can.
Yeah, $400 million in cash. So yeah, they can do both. And the buyback. So here, did they say like during what period will the buyback be? It's like 1 year, like just during the year?
They said it expires in 2027.
So it should be.
So they have a year. Yeah, they have a year to do it. What's the market cap of Dlocal?
It's like 3.3 billion 3.4.
So if they want, they can almost retire 10%.
Yeah, I mean now it's up 10%. So yeah, but yeah, tomorrow it fades and they start the buyback.
March 2027. So yeah, a year. They have a year time to spend $300 million on shares.
This is really a great report, at least.
Yeah. So yeah, it seems like Argentina is now the headwind for gross profit. But I think once we lap these difficult quarters, it turns into a pretty big tailwind for the company, especially if all the reforms and
me or the take rates increased. Check slide 47. Increased considerably. No.
Slide 47 is this one.
Quarter over quarter, it seems to.
Yeah. What is the?
They now say NTR instead of net take rate, so that's why I was confused. But it seems to be the same metric, yeah.
Yeah, gross profit divided by TPV.
Yeah, so very nice to see. So what they say, cost optimization payment. Notably, so this is peaks. That's improvement of 9.7. It's basically peaks. Pedro said last quarter that these types of APMs have a bit of more better gross profit margins, I guess.
Yeah, because the one just before that addresses this, like the minus 15 is talking about the shift towards APMs in Brazil.
There's a new large deal with an existing merchant. So probably the existing merchant in Brazil added more regions, and because of that, the overall take rate decreased. Like they probably bundled another region, and it made the. Does that make sense? Like the minus 15.
Payment method. Here we also see like a huge increase in volume. So this is the volume effect. The first green.
Yeah, the volume effect just says it all. Like that's it. More TPV, it's the way to do it. Because in the end, yeah, it might like decrease take rates sometimes because of some deals with larger merchants, but at the same time, it brings more dollar volume that ends up translating into more efficiency as well. So it's what Pedro is always saying. I guess it's for investors that have been here for several quarters. This is
right. So net take rate did decrease actually, or because if we add, right.
Also, it's like the 103.2 at the beginning. It's like 1.032% take rate.
Correct.
But instead of saying
I miscalculated one thing here. No, because when I look at the bottom here.
Okay, the NTR variation.
Yeah.
Okay.
This is negative.
I see.
Because you have the big hits, because it's not taking this thing here. The volume effect does not get any.
Okay, I get it. This is gross profit and not take rate. The 103.2 and 115.8, it's gross profit dollar volume. The net take rate, it's as you were calculating. Yeah, you're right.
Yeah.
It was impossible to see an increase because they showed like a TPV growth of 70%.
Yep.
And gross profit growth much lower. So I was quite surprised.
Much lower.
Yeah, and it wasn't really making much sense. So this minus $15.0 million is the main reason why gross profit didn't grow as fast. And growth in L2L flows driven by seasonal strength in e-commerce and okay, this is just the mix of cross-border versus.
Yeah.
Okay, so business as usual.
Yes, basically.
Maybe the market may always dislike it. Yeah, it's now up 3%.
Hmm.
Okay, now 6. So it's probably not with a lot of volume. Let me check. Yeah, only 88,000 shares traded in the after hours. So probably that doesn't tell us much about the reaction tomorrow.
Yeah, but I mean, if we look at everything, everything goes like return on equity has improved for the whole year, for the quarter. So gross profit increased 38%, TPV to 70%. So yeah, it's not going to that won't make.
This is an extremely efficient business. NRR 164%. No, 62, sorry. Check slide 41.
Huh. Last quarter was already was
Was
140.
145,
Yeah.
I guess. Wow.
Top 10 merchants. Okay, I guess this is still a big deal, like 62% share of total
Yeah,
revenue.
it's the Mag 7, bro. Like
Yeah.
it's going to be very hard to get out of that. Probably with other regions, but then Mag 7 also growing like everywhere in the world. So yeah, it's a risk and something that should improve over time, but it's very hard for them because it was 149 last quarter, not 145. I was
Okay.
wrong. But as I was saying, it's not good that they are so concentrated in 10 merchants, but at the same time, those 10 merchants are the reason why NRR is 162 because they're trying to grow a lot outside their domestic operations. And probably Mag 7 and all those big corporations are investing a lot in Latin America and Africa and every emerging economy that's Dlocal covers. Dlocals.
Okay. Let's actually see revenue breakdown. So Egypt went up, Argentina is up. Okay, so everyone is basically up quarter over quarter this time. Because like in Q3, we had that huge hit from Egypt, but that has seen a little recovery here. So, okay, so revenue-wise, things are back on track. TPV breakdown, let's see. Pay-in payout still the same, 70-30. Okay.
This NRR is really impressive, man. This means they just didn't need to add any merchant and they would grow revenue at 62%.
Yeah.
What the hell, man? It's just like, okay, guys, just don't do nothing, like anything. Just stay quiet in your desks and we'll print money.
The adjusted free cash flow conversion to net income for 2025, 97% for Q4, 117.
Bring it on, those dividends. You have more than cash.
Yeah, and now with the share
I like
buyback, you can.
Yeah, the share buyback is very good because it will really boost the free cash flow per share at these levels. When I started my position in my like we didn't have the dividend yet, and I was waiting for that extraordinary dividend to be a buyback plan. So this really helps.
The call is in 24 minutes, and I don't think like if we go into the Micron call right now, we'll anyways not hear anything special because it's 20 minutes of prepared remarks. So we'll wait for Dlocal. Yeah, look, they already say here it's up to 300 for 2026, the share repurchases.
Yeah, so it's quite significant.
Yeah. Yeah, it's also good to create a floor for the stock, because every time, let's say we do go back into the $11, they can just say, okay, yeah, we'll just spend 100 million and buy.
Yeah.
So yeah, I do wonder why they didn't give us the revenue guidance. Or maybe they'll just say, look, it doesn't really matter that much, or maybe we can calculate it ourselves.
I think it's because with Dlocal, the way they report earnings makes the real revenue, let's say, be gross profit. If you compare, for example, I think it's Adyen, they report revenue and net revenue, and their net revenue, it's basically the formula that the local uses for gross profit. Revenue is more a function of the volume, and gross, that's why they calculate net take rate as gross profit divided by
TPV.
because that's what the real value of, like, what they're getting really, as if you compare to other types of businesses, as you would get revenue, let's say. So but still they usually say everything. They say, and even operating profit instead of EBITDA, it's also a change, but I prefer operating profit here.
Yep.
But they could include revenue, because that would give us at least an expectation of how they think gross margins will evolve. But based on this, it's clear that they're going to decrease.
They say here, new OPEX baseline post-2025 investment cycle, temporary pressuring the first half of 2026 margins, but driving operating leverage improvements in the second half of 2026. The gross profit here is also already an explanation. Some structural volume-based discounting expected, which is why, again, we're going to continue to see TPV be above 50%
in other words,
growth.
Mag 7. Probably. That's why they say, which is a sign of skill in our long-term merchant relationships. I mean, keep them. Give them structural volume-based discounts. Like, it's totally normal. Like,
at the end of the day, people need to understand that at the end of the day, they are going to keep more money than before.
It's all about dollar volume here. This is a business about dollar volume, not a business about margins.
Yeah,
because even with decreasing margins, the margins are still huge.
Yeah, if I can have a little drop in margin, but I keep more dollars in my pockets, of course I'll take it. And that has been the message from Pedro's from the start. People doubted him and said that these were just excuses because we were seeing a weakness, but I'm not seeing any weakness here. We are going to increase TPV by more than $20 billion in a year.
Yeah. Oh.
Fuck. Very nice. Let's see what the market is saying at the moment. Well, at one point it dropped all the way back to 11.6. And then it did go back up. I guess we'll see what happens during the call. Micron is
day like red.
Wouldn't surprise me. Micron is red, actually.
Micron is red?
Yeah, down 2% now.
But last quarter they also had like a huge beat, then like faded the entire movement, right? Something like that.
For Micron?
Yeah.
Honestly, it wouldn't surprise me, but
I remember because I saw a lot of
maybe
bearish posts saying, "Oh, if not even this huge earnings report from Micron is enough to hold the market, then we're all doomed, and there's going to be a crash. AI is a bubble." Blah blah blah.
Yeah, no, it's possible that it did drop a little bit.
No, I'm checking. It closed up 10%, but at some point it was way higher.
It went down.
And then
Yeah, it also
the day after, it made a new high and like kept making highs like without stopping.
yeah, I still have my rocket ship here. No, okay, so it dropped before the earnings because I think analysts came out with some stupid notes.
Oh, okay.
Increase in investments, there are more competition, blah blah blah. Like the day it reported, it was down 3%, and then the day after it was up 10%. So that's why.
Makes sense. I remember people freaking out about it, even though it was also like a huge report.
Yeah. And now, and even now, if people freak out, don't forget we're literally like $1 or $2 from all-time high. So it's not going to be
Exactly.
a
Like
big deal.
Micron and all the memory stocks are like every dip, like in the day after, it's a new high. I'm out of the run. I have no holdings in the space, but I mean everyone has been watching the insane rallies.
Yeah,
So
I still have my position. I mean, not the full one, but the money that can continue to go. But I'll check afterwards what they say during the call. Like I said, guys, we're not going to jump from call to call, especially not from the start, since
oh,
they
new
just
contract
repeat what
from
they
Rocket
say.
Lab.
New contract from Rocket Lab. Let's see. Ah, yes.
28 launches
For?
with the Department of War. What? Wait.
Let's see.
And we're like we went up 10% yesterday, down 10% today, or even more.
Yeah.
Rocket
And
like
now we're up
11%. Now tomorrow, another day as a Rocket Lab professor.
Yeah, they have. Let me pull this up. Wait. Here we go. So they secure a $190 million contract for 20 haste launches. Okay. And this is led by Undermact something here, led by Kratos Defense. Okay. Rocket Lab will perform 20 hypersonic test flights with its haste launch vehicle over a 4-year period. They also say here that the new award is the single largest launch contract in Rocket Lab history, bringing the total number of launches in backlog to more than 70 and pushing Rocket Lab's total backlog across launch and space systems to more than $2 billion. Okay, so 4-year period, 20 launches for 5 launches a year, basically.
Yeah,
if they
I
want.
thought it would be. But haste is really an underappreciated part of the thesis.
Yeah.
It's really, especially with the geopolitical environment.
Okay. Rocket Lab is, Rocket Lab and also ASTS, every day is like something else. It's either up a lot or you're down a lot. That's the thing with these types of companies. Wait, why does it? Wait, Micron. Let's see. Okay, so good news for Rocket Lab. We are all happy. Anyone else here moving a lot? Let's see. Dlocal is still up 8. And that's about it. Micron is basically down 1.3. So not much on crazy numbers. But then again, NVIDIA was also posting insane numbers, and that stock has been flat for 7 months now.
Yeah, I don't trust now the after hours and pre-market movements.
Especially not for Dlocal.
Yeah.
Uh, 2:30 p.m. Mountain Time. What does that even mean? It's now. Okay. Yeah, now the memory cycle this time is definitely going to last much longer than before. With HBM, with all of these data center build-outs, it's still going to be cyclical, but the cycle is still going to be way, way longer. Let's see, Red Cat. This thing was also all over the place. Someone said 5 below. Don't know. Okay. What's that stock is up 8.2%. Chain of special.
Yeah, it's a discount store like Dollar General, something like that.
Okay, Dlocal stays at 12.3. It's probably going to move a lot whenever they'll start talking. What do you think analysts are going to be asking?
Analysts?
Yeah.
I always ask like questions, like particular questions about each country just for their modeling purposes. Like they never ask, or maybe they will start again asking about stable coins, but now with the AI agents impact, I hope they address it because Pedro has probably a prepared answer. But usually the questions that analysts make are more like short-sighted to help them build their models and their targets and whatever. Like, what's happening with that situation in Mexico? What's happening with that situation in Egypt, in Brazil, whatever? And then take rates, stable coins. It's usually always similar. But I would like to see like a question about stablecoins, but now more in the context of the AI agents and all the FUD that has been not exactly FUD in some ways, because it's really an important thing to consider for this type of companies. But in terms of Dlocal, I think they could end up benefiting from that instead of being harmed. So I'd love to see Pedro talking about it. And also, but I'm not sure if that will be asked, I'd love to know about the acquisition, if it's still going through to happen, because as a finance, when I looked at it, looked like a good fit for the company. And I saw some interviews with the founder and CEO, and she's very nice. I would love to get her on the team. Not sure if that's a plan or like at all, but yeah, I'd love to know more about it.
Okay. Let's see. What did Nebius say today? That they were oversubscribed a couple of times?
I don't think it was Nebius. It was like a news. Someone reported it. I couldn't find who. That's why I didn't post about it. But yeah, okay. I saw like that headline in those news, like portal news, saying Nebius offering reportedly oversubscribed several times.
Honestly, I'm not that surprised. Like the fact that it was upsized means that there is a significant demand for this masterpiece.
And it's also great for the sector overall, because it shows that there's still demand from lenders to help to fund the AI cycle. So
I guess it depends who.
Yeah, it depends on who, of course, but yeah. But it's good for us, and for companies that are not, even like Iron and those companies, like it's good for them as well.
Yeah, I mean, Iron went up yesterday, and today they were down because Nebius was up yesterday and Nebius is down today.
Yeah. But yeah, they're still at 42. I don't really check them that often. But yeah, Nebius is quite close to all-time high compared to the other neo clouds.
Yeah. I mean, we're still far, but we are much closer than the rest when
Yeah,
we look at
still.
where we were compared to where
But yesterday
they were.
not yesterday, 2 days ago we were at 10% from all-time highs.
Yeah. Yeah.
CoreWeave is has to more
Still
than
half
double
of
to
it.
get.
Yeah.
Yeah. Iron not half, but close to it. I don't follow many other names.
Okay, it makes sense because Nebius actually had business. I mean, business changing numbers and announcements that make sense for it to go up.
It makes perfect sense to me, man.
Yeah. I mean, even CoreWeave could be up tomorrow, back above $100, and it would make sense just based on the amount of revenue that they're expected to generate.
The fear, I guess, around the debt situations and all that.
Nebius isn't down today. No. Nebius was down yesterday, was up a little bit today. Swarmer, what is that? The drone company apparently went public.
Yeah, they're Swarmer, and it was up like from yesterday. I think it IPO'd yesterday. Someone was.
Yeah.
It's from today.
One big green candle. This was from today, but let's see. IPO yesterday.
It IPO'd at $10 or $11, and it closed at 55 today.
Wow. Yeah, 520% debut. Not bad. But then again, nobody like us can catch it at 10, 50, even $15 or so. Up. I think we got our big move for now, and then the next move will happen pretty soon. Micron seems to be closing in on being flat after hours. Yeah. Down 0.5. Yeah, Micron's earnings were very good. Priced in or not priced in, I guess the market right now is, again, if they reported yesterday, I think the stock would have been up quite significantly. But today was not a good day. But then again, if the business is performing extremely well, shouldn't really matter what the stock does right now.
I really like the presentations from Dlocal. Oh, this is nice. The buy now pay later volume, like TPV for Dlocal, increased 88% quarter over quarter. Yeah, there. 93% of users are new customers. Minimal carry, yeah.
Okay,
if this continues to grow like this, they will probably start to report that metric like on a standalone basis, Pedro said in an interview. And at this rate, it's hard not to become a significant. But the base is probably still very low, so that's why
Yeah.
the growth.
I mean, it's a new it's a new product from what is it, a couple of quarters ago.
Yeah, but it's good because it has higher take rates.
Yeah, and this is also good. Increases average order value by 40%. Anything else that stood out here? TPV retention rate, 158%. This is like very new holdings. It's also something. Well, did also share a slide like this where they show what the size of their market and the total addressable market. 2.1 trillion, less than 2%. Very, very small fish. Very small fish.
It's going to double in the next 5 years. Crazy.
According to them, yeah. According to Statista Market Insights.
Probably. Exactly. I mean, it's not surprising.
Yeah, this is a huge opportunity because if this is the growth expected, like double the total addressable market, based not even doing much, you're going to grow like crazy.
Yeah, and especially with this NRR, like they can continue to grow at an extremely fast pace, even without like any new merchants or any new products. Obviously, they need to continue to innovate for the flywheel to continue to happen, and for like they can otherwise the merchants switch to a different provider. That's not what I'm saying, but it's not hard for them to keep up with what they've been doing. And we've just gone through an investment cycle that should support that. I mean, Pedro was clear, like when he became the CEO, that there was going to be an investment year or 1 year and a half too, maybe, and that was literally to support the expansion of the next years and the operating leverage that can be achieved in an efficient business like this.
Yep. Let me actually see and prepare the call. Oh, it's very loud music. Okay. Still some music. Yeah, I guess they have a minute left. Would be great if we go back to where were we actually? 16 was. Yeah,
16?
two quarters ago we went up by 31%. We're like at $16.40. Good old days. Since then we have only grown TPV above 50% consecutive quarters.
And accelerating.
And accelerating, yes. And the drawdown has also accelerated. Like the stock went down 30% while we've seen some accelerated growth. Wonderful market.
Watch it go red tomorrow.
Wouldn't surprise me. All right.
We'll open up for questions. To ask a question during the session, you will need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To withdraw your question, please press star 11 again. Please be advised that today's call is being recorded. I would now like to hand it over to the company for opening remarks.
Good afternoon, everyone, and thank you for joining the fourth quarter 2025 earnings call. If you have not seen the earnings release, as always, a copy is posted in the financial section of the Investor Relations website. On the call today, you have Pedro Arnt, Chief Executive Officer, Guillermo Lopez Perez, Chief Financial Officer, Christopher Stroyemeyer, SVP of Corporate Development, and Meirere Aragao, Head of Investor Relations. A slide presentation has been provided to accompany the prepared remarks. This event is being broadcast live via webcast, and both the webcast and presentation may be accessed through Dlocal's website at investor.dlocal.com. The recording will be available shortly after the event concluded. Before proceeding, let me mention that any forward-looking statements included in the presentation or mentioned in this conference call are based on currently available information and Dlocal's current assumptions, expectations, and projections about future events. While the company believes that our assumptions, expectations, and projections are reasonable given our currently available information, you are cautioned not to place undue reliance on those forward-looking statements. Actual results may differ materially from those included in Dlocal's presentation or discussed in the conference call for a variety of reasons, including those described in the forward-looking statements and risk factor sections of Dlocal's filings with the Securities and Exchange Commission, which are available on Dlocal's Investor Relations website. Now, I will turn the conference over to Dlocal. Thank you.
Good afternoon, everyone, and thank you for joining us today. 2025 was a year of exceptional execution, one that proved the strength of our business as we continue to build a world-leading financial infrastructure platform for emerging markets. Our business flywheel is accelerating. High growth in a massive and expanding TAM, strong customer loyalty and retention, a growing capacity to innovate, and an asset-light, high-cash conversion financial model. We demonstrated the scale of the emerging market opportunity. Our TPV reached $41 billion, up 60% year-over-year, and accelerating as the year progressed. Revenue crossed the important milestone of $1 billion for the first time. We continued to deepen our merchant relationships. TPV retention reached 158%, and net revenue retention 145%. Both strong testaments to the value of the service we offer and our ability to ride the secular waves of emerging market growth alongside our merchants. We also continue to advance our developing innovation engine. Buy Now, Pay Later Fuse products are now live across 6 countries with solid merchant adoption. We've completed the launch of our full-service stablecoin suite, enabling merchants to on- and off-ramp fiat to stablecoins, settle and be settled in stablecoins, and collect at checkout in stablecoins. And we continue to add an ever-growing portfolio of APMs to the Smart APM platform. We also delivered strong cash generation in the year that ended. Adjusted free cash flow was $191 million, up 110% year-over-year with a 97% conversion ratio. All this strength in our P&L was driven primarily from our sustained TPV growth with merchants in 2025. Flowing on from TPV growth, gross profit grew 37% year-on-year, and despite a still active investment year, we expanded adjusted EBITDA as a percentage of gross profit by 5 percentage points, underscoring the operating leverage inherent in our financial model. As a consequence, net income reached $197 million, up 63% year-over-year. Taking a step back, it's important to acknowledge the consistency of our TPV growth over our entire history. From 2020 to 2025, TPV has grown at an 82% compound annual growth rate, yet hasn't really decelerated that much when we see 60% plus growth in 2025. At the size we have today, these high levels of growth drive significant incremental dollar volumes. Case in point, In Q4 2025 alone, we added more TPV quarter over quarter than in the prior 3 quarters combined. The scale of this is worth pausing to reflect on. In 2025, we processed in a single day what we processed in all of 2016. Over the year, we handled approximately 3.5 billion pay-in transactions, which is equivalent to around 6,700 payments every minute, every hour of every day. On the payout side, more than 100 million individuals received a payment through Dlocal. And so despite it still being the early days for our company, this kind of scale sets us up well for competitive advantages in costs, operating leverage, data accumulation, and organizational knowledge. We now process payments in 44 markets across the Global South, nearly doubling our footprint over the last 5 years. With an increasing number of markets becoming meaningful contributors to overall volume. 2025 also represented acceleration in financial metrics. When we compare our 2021 to 2024 gross profit, adjusted EBITDA, and net income against our 2025 growth rates, the sustainability of high levels of growth at much larger size is clear across every line. The business continues compounding solid growth even as it scales. And there's a reason for this. Merchants are increasingly global, but financial infrastructure remains local and ever more complex and locally regulated. Emerging markets continue to be defined by fragmented payment infrastructure, regulatory complexity, and rapidly evolving localized consumer behaviors. These structural challenges are exactly why our platform exists and has such wide adoption among the world's most successful digital companies. We address complex financial infrastructure challenges that our merchants lack expertise in and prefer not to focus on. And there is still room to continue doing this for a very long time. I'd like to share a few examples of such complexity. We now hold 37 licenses across 26 markets, adding 4 in 2025 alone, including Argentina, Chile, the UAE, and the Philippines, with 16 additional applications in process, including for the United States. Without these, serving customers with the local financial infrastructure that their consumers expect would not be possible. Alternative payment methods already account for the majority of e-commerce volumes across EM markets, and our APM volumes continue to grow as we deepen capabilities around tokenization, biometrics, improve regulatory compliance, and increasingly offer instant rails being built across the Global South. On stablecoins, we offer a full suite of stablecoin solutions for merchants. And on AI agents, a possible new frontier for commerce, we are collaborating with Google on the AP2 open standard for interoperable AI agent payments to ensure local payment methods across emerging markets are part of that infrastructure from the ground up. Most importantly, we simplify and abstract away all this complexity through a single, unified, world-class platform. Our ability to offer one integration covering the widest and deepest footprint across the Global South, the most markets, the most payment methods per market, is our durable differentiator. That is the one Dlocal proposition. And the more complex the environment becomes, the more valuable it gets. I think it's worth highlighting a few examples from this last quarter alone that exemplify what I've been talking about. On stablecoins, we now offer merchants a complete infrastructure suite for digital assets, from treasury and FX through on and off ramps, all the way to stablecoin acceptance at checkout and settlements in stable. With leading partners including Circle, BVNK, Fireblocks, and Felix. On Buy Now, Pay Later, our Fuse product grew 88% quarter on quarter during the fourth quarter, a clear signal that merchant and consumer appetite for installment-based payments is real and rapidly accelerating. And on alternative local payment methods, we continue expanding depth and intelligence across markets and use cases to deliver improved performance, from biometric authentication and tokenized card on file to instant payment rails. DHL Express and Open English are among the latest merchants to go live with these capabilities. APMs currently account for a significant portion of our quarterly TPV. The value to our existing merchants of the product and service model we offer becomes clear when looking at our retention metrics. As merchant rides the secular trends in our markets, scale into new geographies, and adopt new payment methods or expand them into new use cases, Dlocal grows with them. This is the compounding nature of our model, reflected in our TPV retention rate and net revenue retention. Equally important to our growth algorithm is the size of the market we are pursuing. Estimates place the total addressable market for digital payments across emerging markets at over $2 trillion and expect it to double by 2030. And we currently hold less than 2% of that market, while our share of wallet with existing merchants is only approximately 10%. We're scaling fast, and yet the runway ahead remains enormous. This dynamic is also visible in the breadth and depth of our merchant base. Total merchant count reached more than 760 in 2025, and the diversity of that base continues to increase. Revenue concentration in our top 3 markets has declined, and our top 10 merchants account for a lower share of total revenue than in the prior year, reflecting broader platform adoption across geographies and verticals. And while admittedly concentration remains, the business has become not only increasingly diversified, but also stickier. Today, we serve our top 50 merchants across an average of 12 countries and 50 payment methods. That multi-country, multi-payment method engagement is the clearest expression of the resilience and compounding nature of what Dlocal has to offer. All along, these results have been delivered with best-in-class efficiency. Our gross profit per employee has improved despite continued investment levels, with AI and automation as growing key enablers. In 2025, AI-driven automation delivered the productivity equivalent of roughly 7% of total headcount, allowing us to scale without proportional cost increases. More importantly, we expect further progress throughout this year. We have a clear, self-reinforcing logic to our business model. High growth drives scale drives efficiency, and efficiency generates the cash we reinvest to extend our lead or generate greater shareholder returns. This continued our track record of strong cash generation, which positions us to reinvest in technology, product, and commercial capabilities while maintaining sufficient liquidity and returning capital to shareholders. As previously announced, I'm very pleased to have Guillermo López Pérez on board as our new Chief Financial Officer. This will be Guillermo's first earnings call in the role, and we're all very excited to have him leading our finance organization. And so with that intro, let me hand the call over to him.
Thank you, Pedro. I am thrilled to have joined Dlocal and to be part of this team's next chapter. And good afternoon, everyone. As I shared with some of you in London a few weeks ago, the opportunity ahead of Dlocal is enormous, and the business this team has built over the past 10 years is exceptional. I look forward to having more conversations with you in the coming months about how we are strengthening and scaling Dlocal. So Pedro walked us through some full-year results. Let me focus on our performance in the fourth quarter. TPV surpassed $13 billion for the quarter, growing 70% year-on-year and 26% quarter-on-quarter. This is our highest quarterly volume in Dlocal's history and our fifth consecutive quarter of above 50% year-over-year TPV growth. A sustained trend that reflects the strength and consistency of our business. As you can see as well, we are exiting 2025 with very strong momentum in TPV growth. This growth was broad-based across our key markets and verticals. It was particularly strong in Brazil, Mexico, South Africa, and Colombia. On the vertical side, on-demand delivery stood out in the quarter, driven by existing merchants ramping up expansion deals across Argentina, South Africa, Mexico, and Colombia. E-commerce continued its positive trajectory, delivering a seasonally strong quarter, particularly in Mexico, Brazil, and South Africa. And advertising recovered quarter-on-quarter, supported by the partial return of volumes in Egypt. Q4 was a strong quarter to finish the year as well from both a revenue and gross profit perspective. Revenue reached an all-time high of $338 million, up 65% year-on-year and 20% quarter-on-quarter, demonstrating that our TPV momentum is translated into very strong top-line performance. Gross profit reached $116 million, up 38% year-on-year and 12% over Q3. It reflects the natural margin pressure dynamic of scaling volume with established merchants and into new payment methods, products, and countries. But even with that natural margin pressure, we added $32 million of gross profit year-over-year in the quarter, nearly a 40% growth. On a sequential basis, besides higher local-to-local volumes and the typical Q4 e-commerce seasonality, the gross profit story was driven by 5 main contributors. Brazil led the growth, where we saw very strong seasonal e-commerce growth supported by solid trends across streaming, advertising, financial services, and remittances. Egypt partially recovered versus Q3, reflecting the return of a large merchant and the ramp-up of new e-commerce, streaming, and ride-hailing merchants. Mexico contributed thanks to a strong volume growth in e-commerce, on-demand delivery, and ride-hailing, and other Africa and Asia contributed with broad-based growth, with a notable contribution from South Africa, where we are increasingly operating with more global merchants. Argentina, on the other hand, was the primary drag to growth. While underlying volume growth was very strong, gross profit was held back by higher cost amid election-related effects and rate volatility. Q4 continued to demonstrate the operating leverage inherent in our business. Total operating expenses were $53 million for the quarter, up 28% year-on-year, driven primarily by our investment cycle-related headcount growth and higher average salaries following our merit cycle. Adjusted EBITDA reached $78 million, up 38% year-on-year and 9% quarter-on-quarter. Starting 2026, we are introducing operating profit to provide investors with greater transparency into our operating performance. As the business scales, adjustments represent a declining share of revenue, and we believe this metric offers a more standardized basis for comparison with industry peers. Net income totaled $56 million for the quarter, up 87% year-on-year and 7% quarter-on-quarter. Year-over-year growth reflects a lower effective tax rate in the quarter, driven by a more favorable jurisdictional mix, and the non-recurrence of a one-time tax settlement recorded in Q4 of last year. Return on equity reached 35% on a last 12-month basis, up 10% points year-over-year, and continuing to increase every quarter. The improvement in ROE reflects both a stronger profitability and the effects of our capital return policy, mostly the inaugural dividend payment in 2025. Finally, adjusted free cash flow for the quarter was $65 million, doubling year-over-year, with an adjusted free cash flow to net income conversion ratio of 117%. The quarterly conversion can fluctuate with items like tax payment timing, but on a full year basis, we converted close to 100% of net income into free cash flow. This is a business that converts growth into cash at an exceptional rate. With that, I'll pass it back to Pedro, who will speak to how we are deploying this strength.
Thank you, Guillermo. 2025 confirmed what we've long believed. The opportunity in emerging markets is massive, our model is the right one to capture it, and our team executes consistently across a complex and dynamic environment. We enter 2026 with a clear strategy, a strong platform, and a proven track record. This year also marks 2 milestones: 5 years as a listed company and 10 years since our founding. A reminder of how far we've come in so little time and how much of the opportunity still lies ahead. Let me turn to our outlook for 2026. We expect continued strong growth in the key market share and product market fit measurement that is total payment volume. We currently see TPV growth in the range of 50 to 60% year-over-year. Greater volume drives pricing leverage with downstream providers, improves FX liquidity, and generates better data that feeds conversion rates. This is the compounding logic that excites me the most about our long-term trajectory in this business. We're guiding for gross profit growth of 22.5% to 27.5% year-over-year. As existing merchants grow and large clients continue to scale, we expect more volume-based discounting that is embedded in our long-term customer relationships. At the midpoint, this implies gross profit dollars, what we managed to, of $500 million in the year. On profitability, we are guiding for operating profit growth of 27.5% to 32.5% year-over-year. Following a 2025 investment cycle, which has overhang into early 2026, as salaries and wages spend from 25 hirings gets annualized, we expect operating leverage acceleration to become evident more towards the second half of the year and then flow into the following year. As a reminder, emerging markets remain inherently volatile, and our projections reflect those uncertainties. These conditions are not new to us. We've built this business to navigate exactly this kind of complexity, and we remain confident in our guidance. We believe we are only scratching the surface of the opportunity ahead when I take a longer-term view. So I wanted to leave you with a way of thinking of that opportunity further into the future. First, the growth of our existing merchants in markets where we serve them today. The world-class companies we serve are riding some of the strongest secular trends: digitization, middle-class income growth, and e-commerce penetration. In many cases, there are entire lines of businesses for which they have not yet localized their payments infrastructure. Second, geographic expansion with existing merchants. We serve merchants across an average of 12 countries today, but we operate in over 44. Further expansion into Asia, the Middle East, and Africa, where we see increasing merchant interest, will be an even greater growth vector going forward. These two elements are what will drive increases in our consolidated share of wallet of our existing merchants. And they also explain why we expect continued high TPV retention rates with these merchants. On top of that, our growth will be powered by new merchants. Our last 2 years have been predominantly driven by the strength of our existing base. However, we're seeing strong commercial traction with new merchants across priority verticals such as travel, crypto, gaming, and AI as they move further along the emerging market payment adoption curve. We expect new merchant contributions, therefore, to increase over the medium term. And fourth is our innovation engine. While near-term P&L impact is still expected to be modest, we see multi-billion TPV opportunities in our wider financial infrastructure bets, such as buy now, pay later, enhanced merchant of record solutions, virtual accounts, and our soon-to-launch card-present offerings. Finally, and before I close, I'd like to cover capital allocation. We continue to have enormous confidence in the cash generation capacity of Dlocal. The asset-light nature of the business, negative working capital requirements, and potential for operating leverage ahead of us gives us a growing free cash flow profile, even under conservative projection scenarios. In addition, we currently operate with minimal debt, and while we remain disciplined, do not rule out using it in the future as a way to secure additional cash or enhance the efficiency of our capital structure. Our allocation framework is structured around 4 priorities. First, invest to sustain high levels of growth that we aspire to. Second, ensure the appropriate liquidity buffers given the volatility of the markets where we operate. Third, selectively be prepared for M&A if it accelerates our strategy. And fourth, return excess capital to shareholders. On this last point, through the end of 2025, we have returned 64% of adjusted free cash flow generated since 2022 to our shareholders. We intend to maintain this disciplined approach to capital returns going forward. Consequently, we're confirming our dividend policy of 30% of the prior year's free cash flow, which this year translates to $57 million. Additionally, and upon thorough analysis and consultation, we believe that our business will generate sufficient cash in the medium term beyond our minimum liquidity requirements and dividend policy commitments. This allows us to increase returns to shareholders. As a result, the board has approved a new share repurchase program of up to 300 million of our Class A common shares. The policy is a first step in what should become a multi-year capital allocation model that combines the predictable discipline of our dividend policy with add-on allocations for share buybacks that will prove accretive to EPS. The precise quantum of these plans will be determined by multiple factors, among them trading volumes to ensure the adequate liquidity for our shares, continued confidence in excess free cash flow generation, and analysis of the potential for other areas of investment that can generate even higher total shareholder returns. We trust that these corporate finance decisions and programs highlight our commitment to be prudent allocators and custodians of your capital as shareholders in Dlocal. And now, finally, these are turbulent times. So, to close, I want to highlight what makes our story special, and more importantly, durable. We have a business that is growing rapidly, highly profitable on a cash basis, with low leverage and high and increasing return on equity. That combination of growth, profitability, and financial strength is rare. As a team, we remain fully focused on the long game, disciplined growth, continued product innovation, and sustainable value creation for our merchants and our shareholders. The opportunity across the emerging market landscape is vast. Our platform is uniquely positioned to capture it, and our track record gives us confidence in our ability to continue to execute against this strategic vision. Thanks everyone for your continued support, and we can now open the call to take your questions.
Thank you. To ask a question, you will need to press star 11 on your telephone and wait for a name to be announced. To withdraw your question, please press star 11 again. Please stand by while we compile the Q&A roster. One moment for our first question. Our first question will come from the line of Tito Labarta from Goldman Sachs. Your line is open.
Hi, good evening. Thanks for the call and taking my question. A couple questions, I guess, to start. First, on the TPV growth guidance, as you mentioned, Pedro, continued strong opportunity for growth there. Just if you could give a little bit more color on where you're seeing the growth come from this year. Is it a continuation of like Brazil, which has been growing quite a bit, more in Africa? Just any color that you can give on where you think the TPV growth will come from by country, by vertical, also like e-commerce has been strong. Any color on that, I think would be helpful. And then my second question, specifically on the quarter in Argentina, we saw actually very good revenues, gross profit were lower. I mean, I think you mentioned FX and some other things impacting costs, but how do you think about the gross margin in Argentina? Should we think of this as a one-off this quarter, given everything going on there? And should that gross margin sort of recover to levels that we saw before? Just to think about the growth that we can expect, not just on revenues, but also gross profit for Argentina. Thank you.
Great. Thanks, Tito. I'll take the first one. I'll leave the second one to Guillermo. So the strength of our business continues to be broad-based in terms of the guidance. Latin America will continue to deliver strong growth. We consolidate our position further in Africa with some critical markets there sustaining growth. We've seen Egypt pick back up in the fourth quarter, and we assume that that rolls into the 26 guidance. And we're also becoming increasingly ambitious in the Middle East and in Asia, where despite being a late entrant, we do see significant opportunity and will lean into that market as a long-term growth vector. The other part that we indicate, if you look at page 27 of the slides, is we also begin to see increasingly a better distributed set of growth vectors in the guidance. Whereas our 25 results were extremely concentrated on share of wallet gains and organic growth of our existing merchants in existing countries. When we take our bottoms-up approach and probability adjust our pipeline to get to the 26 guidance numbers, we begin to see more participation coming from taking those merchants into new countries, which shows the depth of the relationships we're building and also the growing importance of frontier markets and smaller markets within the emerging world footprint, as well as our expanding footprint into more parts of the globe, for example, Asia, as I just mentioned. And then also we expect a pickup in new merchant impact in year one, so a very strong cohort. And finally, still small, but I think if we take a midterm view, a very, very important part of what we're building are our new products.
which allow us to further monetize and gain traction with our merchants. And more importantly, many of these ideally also become take rate accretive because they are higher monetization products.
Okay, so hi Tito, let me take a stab to your question on Argentina and feel free Pedro to chime in. So Argentina had a significant rate and FX volatility leading into the elections in Q3. I think this macro volatility was already mentioned in the previous earnings. Unfortunately, we saw it remained elevated throughout Q4, which affected the cost of the funding sources that we use for our advancement business. But I think on a positive note, we continue seeing very strong volume growth, and Argentina remains a highly attractive market for us. It is one of our fastest growing countries, and when we calculate the returns on capital deployed, it is well above our cost of capital. So our thinking on Argentina is it is high growth, high return market, despite this intrinsic volatility that we have seen.
Okay, no, very helpful, Pedro and Guillermo. If I can, just two quick follow-ups on each. So we should expect that gross margin, which kind of suffered from the FX volatility, as the FX normalizes, that should recover maybe closer to what we were seeing in the past. Is that correct for Argentina? And Pedro, just curious on the stable coin buy now, pay later. I mean, you mentioned those as opportunities. When do you expect those to become, say, sort of like significant to contributors? You expect already in 26? Is it more 27, 28 story? Just to think about the potential there and how much that can contribute. Thank you.
So 26 is more about the confirmation of product market fit and solid growth. We gave an idea of quarter-on-quarter growth in buy now, pay later above 80%. Now, obviously coming from a small base, so it still doesn't move the needle. Unlikely that it moves the needle in 2026, but compounding at those levels of growth sequentially by 2027, ideally that does become material in our P&L. And then on Argentina, we'll comment on how the market evolves when we get into it. As you know, Argentina is a particularly volatile country. I'd rather not be making forward-looking statements. I think Guillermo's point was, if we abstract ourselves from the short term, we look at TPV growth, we look at merchant interest in the country, we look in general at a country that seems to be on the right track, we expect a lot out of Argentina over the long term.
Okay, no, that's very clear. Thanks a lot, Pedro.
Thank you. One moment for our next question. Our next question will come from the line of Guilherme Grespan from JP Morgan. Your line is open.
I thank you, Pedro, Guillermo. Congrats on the quarter, very strong print. Two questions on my side. The number one is just on stablecoins. You mentioned a little bit on stablecoins, buy now, pay later, APMs, but specifically on stablecoins. If you are seeing any pickup, Pedro, or not in the volumes of stablecoins, I think on the treasury of Dlocal makes more sense. Maybe it's picking up, but my interest is more on the pay-ins and kind of adoption in EM. If we're seeing any signal that the stablecoins technology is already picking up in some way. And then my second question is just to check the box on United States license. Should we read this as a UK license similar to that movement, or it's specific to any service or product here? Thank you.
On stablecoins, we are not seeing significant volumes or pickup in stablecoin at checkout. We do begin to see growing interest in merchants in understanding the product that we've come to market with, understanding regulatory requirements and how each market works. But I would not say we've seen volume. Where we're seeing the most volume within that vertical is serving digital asset marketplaces, exchanges with the fiat legs on the way in and the way out, so what we call pay-ins and payouts, and then increasing and growing conversations with corporate treasuries and our clients' treasuries on the usage of stablecoins in particular markets where they may have a cost benefit or a speed benefit or a 24/7 settlement benefit, which I think over the next few years will probably be the largest of those three segments that we offer products around, which is stablecoins as a payment means or a settlement means, stablecoin on and off ramps to fiat, and corporate treasury adoption.
That's clear.
Thank you. One moment for our next question.
Sorry, no, there's a second part to his question, or a second question, which was on US licenses. We continue to be solely focused on the emerging market global footprint. As I said, we're very excited in our forays into the Middle East and Asia. So there's not an ambition here to offer developed market solutions. We see our strength and our differentiation and our ability to leverage over 10 years of building infrastructure and pipelines across the emerging world. Those licenses just facilitate settlements to merchants and simply allows us to operate on our own licenses in an increasing compliant way rather than have to rely on licensed partners.
Thank you. Now for our next question, we'll come from the line of Pedro Ledus from IBBA. Your line is open.
Hi, good evening, everybody. Congratulations on the strong close of the year. First question on Brazil, revenues and gross profits. Gross profits growing much faster than revenues here this quarter. So wondering if you could detail to us a little bit if it's product mix, client mix. Second, if you want to develop a little more on what dragged up the G&A expenses this quarter. And there's a comment that in the prepared remarks that operating leverage should kick in the second half of the year. We see it portrayed within the profit and gross profit guidance. But if it's something that we should also expect this 4Q level to be still upon us here in this first half of the year. And if I may squeeze in a third, just to clarify, I think there was a comment about present card operations going forward. If you want to detail a little bit more about that. Thank you.
Okay, on Brazil, I would say in general, Brazil really has begun to rebound. If we look at the TPV growth, it shows this tremendous strength in that market. And then Brazil also benefited from very strong monetization. A portion of that is, it's one of our largest markets. It's where we have a lot of TPV from mid-tiered merchants, which typically have slightly higher take rates. The vertical mix there with advertising performing well, that usually tends to be a slightly higher take rate. But it was a particularly strong quarter. I don't think that level of dispersion between TPV growth and gross profit growth is something that you should necessarily project into the future. So very strong in general, structurally strong. Really glad to see Brazil turn around after a difficult 24. There's also an easy comp to a certain extent, but I think mission accomplished by the team there. And we always said that we were confident that 24 was more about volatility and that there was still significant growth for us ahead in Brazil. It was particularly strong. I don't think that kind of strength necessarily should be extrapolated into the future. On G&A, very quickly, because I think we tried to explain this, but important to understand the cadence into the quarter. If you look at our year, a lot of the growth in headcount within our investment cycle was more backloaded to the second half of the year than the first half, not necessarily by design, but the way it played out. So what you're seeing there is very much driven by increased investment in engineers, in commercial teams, and in operational teams. And that does have a spillover into 2026. I'll let Guillermo cover that, but I think it's relevant.
Yeah, I think if you asked specifically about G&A, I mean, there were some one-off items, but actually you normalize for them these non-recurrent items. The underlying trend on G&A is consistent with what you see in the rest of OpEx. And the story of OpEx is for our Q4, it reflects the last leg of the hiring coming out of the investment cycle that Pedro started 2 years ago. We invested mostly in headcount, and there's also a component of our annual merit cycle increases. Now, to help you understand how this is going to pan out in 2026, we are not planning to add any significant headcount at this point in 26, beyond a few hirings already in motion at the end of 25. But given this 25 hiring is backloaded in the year, you should see higher levels of OpEx year-over-year growth in the first few months of 26, and these costs are annualized. This growth should reduce in the later months of 2026. But overall, we expect OpEx growth for the full year to be below gross profit growth, and the operating leverage embedded in our guidance is primarily going to be a story for the second half of the year. It is worth noting as well that when you compare us to our peers, as we show in the presentation, we believe we are among best in class in terms of the resources required to run a business of this scale and growth rate. And I think that's a reflection as well of the operating model that we built, and we're very comfortable with the levels we are maintaining.
You had a third part to your question. I didn't jot it down.
There's some mention about card present transactions that you're going to operate. Maybe I misunderstood it, but there's something in the call that mentioned that.
Yeah, that's part of our innovation pipeline. I think there are select verticals where we have inbound interest from merchants who would like to use the Dlocal technology stack embedded in smart hardware and smart POS. So that would be our first foray in being able to capture some share of wallet in card present processing, which is by far the largest market. If you look at Dlocal until today, 100% of the merchants we process are digital merchants, so not card present transactions. And through this new card present platform we'd be launching, it would allow us to start having some share of wallet of the card present market. Still focused a lot on global international merchants, where the advantage of one integration and then being able to deploy that across multiple markets remains unchanged. We're not changing our go-to-market strategy, but it does open a very large addressable market for us.
Amazing. Thank you so much.
Thank you. One moment for our next question. Our next question will come from the line of Matt Code from Truist. Your line is open.
Hey, good afternoon, guys. Thanks for taking the question. Pedro, just wanted to do one more on the card present offering there. Could you kind of like touch on, I assume that's more of like a 2027, 2028, even maybe 2029 story. But could you talk about if there's any kind of like upfront OpEx investment in 2026 to drive some of that growth? And then just second question, seems like the large merchant coming back on board in Egypt is a pretty unique situation, bodes pretty well for Dlocal. Could you guys kind of provide a little bit of color there? Like why, did you lose share of wallet and why ultimately did the merchant come back to Dlocal? Thank you.
Great. Let's see. I don't want to get too dragged into this card present thing to not make too much out of an embryonic product launch. Everything we build is actually typically very determined by a specific merchant contract that's existing, and therefore rarely ever do we invest significant OpEx ahead of having concomitant revenues backing it up. And I think this is yet another case where we will build alongside our client, and that allows us to gradually see if there's product market fit and how much more interest there is for what we're building and how much we can grow with that initial merchant. And in general, that's one of the reasons we're so encouraged by the cash generation of our financial model, is that we don't really make big investments ahead of existing real enterprise merchant demand to fund the build out of the products. Egypt. I think Egypt, we've walked through this. I think regaining share of wallet is phenomenal. It doesn't surprise us, but losing it in the first place, we explained. This was a merchant that we had 100% share of wallet in. The merchant started rolling out redundancy, and in the initial phases of that redundancy, we lost a significant amount of that share. And through performance, we've gradually been recovering it. We will never return to 100% because the merchant understandably will always have redundancy. But certainly, at least over the last quarter, it's been one of recovering a lot of the market share that was initially lost when we moved to 100 to sub 50%.
I think the other thing to add on Egypt is, we're diversifying our business with the ramp up of e-commerce, streaming, and ride-hailing merchants. So it's good to have and see that diversification.
Super helpful, guys. Thank you.
Thank you. One moment for our next question. Our next question will come from the line of Jamie Friedman from Susquehanna. The line is open.
Hi. I appreciate the new disclosures, especially slides 12, 13, and 27. So I want to ask about those. So in terms of so if you don't have in front of you, the share of wallet analysis on slide 12, I think is important. So if I'm reading this right, you're getting 300 basis points of share of wallet increase year over year is your estimate from your installed base, if that's right. I'm just trying to reconcile that slide 12 with slide 27. How do we, think about the share of wallet contribution to growth going forward, and the contribution from new merchants, which you're articulating, is expanding next year?
Hi, Jamie. So I think you've understood correctly. Slide 12 is an actuals breakout of what was driving growth, which then informs the left-hand column of the slide further down. And if you look at 25, our TPV retention was phenomenal. And within that retention, it was very much driven by the growth of our merchants in the markets where we already served them, and share of wallet gains within those merchants in those markets. So think of that almost as the enormous expansion of the existing market we're in. And that's one of the great things about emerging markets, is just riding the growth of our business partners as emerging market consumers become more and more digital and consume more and more of these global digital products, gives us significant growth. On top of that, as we gain share of wallet in some of these merchants, things play out as they did in 25. What we see in our pipeline for 26 is that we see a pickup in growing into new markets with those merchants, better impact coming from new merchants. So we're beginning to see increasing pickup in new merchants globally looking to localize payments. And so we expect a lot out of the 26 cohort. And then finally, beginning to see, as I said before, product market fit and new products coming to market, whether that is buy now, pay later, card present, virtual accounts, and a few other things we've indicated. If you take a longer term look, what we'd like is to see new products and new merchants increasingly becoming a bigger and bigger part of the growth story.
And then if I could just follow up, Pedro, with the new merchant contribution contemplated for 26, the slide 27, 10%, I would have thought that those would be accretive to the gross profit take rate, because they probably don't have the volume discounts because they're new. Is that a fair assumption? And because that is a bigger number next year than this year. So, why is it that we're landing at like an 80 basis point gross profit take rate at the midpoint next year if new merchants are ramping the way that they are?
So I think that's a generalization, and it depends very much on the new merchant and the new merchant potential, and the size of their projected volume as well. So if you have the possibility to engage in a conversation with some of these new gen companies that are growing 11x Q on Q and convince them to adopt localized payments, I think you're going to focus on volume there and give them an attractive take rate. So it's not that easy to generalize. And I think more importantly, and again, sorry for being so reiterative on this, but the more we look at the size of the emerging market opportunity, the more convinced we are that the single most important thing for us is to continue to grow total payment volume, to continue to drive to max scale, and to not lose merchants or lose accounts on trying to maximize for take rate. At the end of the day, at high TPV growth, which drives incremental gross profit dollars and solid gross profit growth, with operating leverage, which drives even more solid operating income growth, we get the best of both worlds. Long term, we guarantee that we continue to be one of the scale leaders across emerging market. And we feel fairly confident that if you have the merchant relationship and you're processing for them, we will figure out ways to monetize those relationships and all that TPV. So focused on TPV growth, focused on gross profit dollar growth, and being scale leaders across emerging markets is what's implied in the guidance. Not all new merchants that come in necessarily come in at higher take rates. It depends on the vertical, and it depends on the size and the potential of the new merchant. The new products do all tend to be accretive to take rate, but those are still quite small in terms of their impacts in the 26 guidance.
Thank you for the context.
One moment for our next question. Our next question will come from the line of Neha Agarwala from HSBC. Your line is open.
Hi, thank you for taking my question. Congratulations on the results. Just quick clarification on the OpEx. From what I understand, you're done with all the hirings that you needed, most of the investments in 2025. The reason why the operational efficiency will be visible more in the second half of this year is mostly because of base effect, because some of those expenses will weigh on the first half, right? But most of the investments, the changes that needed to be done, those are already done. We don't have significant investments per se in 2026. And my second question is, where do you see upside or downside risk to your guidance? What are the main factors that we should watch out for during this year that could bring in volatility or divergence from the guidance that you've provided? Thank you.
Okay, let me take the first one. I handle the second one to Pedro. So you're right in the way you're thinking about OpEx. We did a lot of the hiring in the second half of this year. There were just a few handfuls of positions that were open at the time that can come in 2026. But from an OpEx perspective, what you're going to see is the annualization of those late in the year hirings panning out in 26, and so you will see that high year-over-year growth in the first few months, and that should normalize and come down in the later part of the year, in which we are predicting a reduction in the level of growth. That's correct.
Great. Let's see, I don't want to give you a trite answer. Clearly, as an emerging market operator, global macro, geopolitical, and primarily how that flows through to FX are the clear, we don't control, we don't know, but they can have an impact on our results. I'd say if we take a more micro approach within the things we do control, probably the largest risk, and this somewhat also answers Jamie's question on the take rate implied, is there have been some very strong global wins with some of our large merchants. I think the way we like to say it is we feel like we've moved into a new category of partnership with many of the world's leading digital companies, where we now are one of their largest global payment processors, operating for them across multiple markets across the emerging world. And the expectation of the delivery on those contracts is a big part of the growth in 2026. So it is guidance that remains concentrated in a merchant perspective, less and less so in a country perspective, because we're serving these merchants across many, many more markets and payment methods. But that's probably the biggest risk, is that we do have to deliver on these net new adds in terms of markets and payment methods, so that we continue to roll out everything that has been jointly agreed to in these large global contracts, where we become one of their most important and trusted global financial infrastructure providers.
Great. Thank you. Thank you so much for those answers. So, I mean, if I put it differently, you said it probably there's upside risk to their volume growth with more of these big wins coming through, but your ratio, which is the take rate ratio, might get diluted because of that, but because you are very focused on volume growth, as that's the right strategy for the long term.
Gross profit growth, operating profit growth, obviously earnings above all else, and convinced that this is a race to scale, as payments and financial infrastructure always are. And that, as I said before, if we have the TPV, we have the merchant relationships, as our product portfolio widens, we have that TPV and those relationships to cross-sell new products, and also to figure out different ways that we can help our merchants across the markets where we operate with them. So we continue to see take rate as an output metric. The metrics we manage to are TPV growth, which reflect market share, share of wallet, and how our merchants choose. Remember that TPV for us is revenue for our merchants, and then be able to drive gross profit growth, operating profit growth, and earnings growth as a consequence of that sustained high level of compounding TPV growth.
Perfect. Thank you so much.
Thank you. And with that, this concludes the question and answer session. Thank you for your
All right. Stock-wise, still the same. I think it's still up 7% or so.
It hasn't been moving much, even on a volume level.
Which makes sense again. I don't think volume is this name's best friend anyways.
Yeah,
okay,
I'm glad it's like, as a someone traumatized by fintech, it's not a bad reaction.
Yeah, what did you, because what was one of the, let's say, top three, if you have top three, because there were a lot of repeated questions and answers, top three things for you mentioned here?
To be fair, I don't think there are many like specific things that you could point. I think mostly the everything. I feel like we repeat everything the same in each quarter, because the business remains the same. They're executing on a very, very high level, and I think the thesis for has always been not only about the nature of the business, but also about Pedro Arns coming as a CEO, because of his experience in Mercado Libre from the beginning. He will spend there like 20 years. It's literally from when the office was in a garage. so he clearly knows what he's doing. And every quarter, he shows that he has the ability that some managers don't, and in most of the businesses, it's what should happen, which is knowing what are your most important long-term KPIs and being laser focused on that, and like not having short-term optics or being focused on performing well in the next quarter. I think he knows clearly what he and the entire team needs to do to drive in the long term, and he doesn't get affected by what analysts or what investors think, and that's really something I appreciate. So I love that he's still focused on TPV all the way. He's always tells analysts, yeah, we don't like. It's not like we don't care about take rate, but if take rate has to go down for the TPV to continue to grow at an insane pace, then we're going to do it, and obviously that's nice. Something I found interesting is that he said they might consider debt in the future, which they never, at least I don't remember the last time they had debt. But I understand that it could be efficient from a balance sheet perspective. There's always some ideal level of debt. So if done properly, it could reduce the overall cost of capital if it's lower than the cost of equity. So that's not bad at all, but something that was surprising. I also found it interesting that he said stablecoins for now are not really meaningful. Like they're seeing a lot of chatter about it from merchants and like industry stakeholders. And he said that in the next 2 years, it will pick up mostly on a corporate treasury, I believe, part because of the 24/7 settlement, like the stablecoin advantages, basically. But until today, there hasn't been that much volume coming from stablecoins, which is interesting considering all the panic that we've been seeing, like even in Visa and MasterCard. So I found it quite curious. I like that they continue to push for new products like the gift card, probably not relevant in the short term, but it shows that they are trying to find other ways of compensating the decreasing take rates, like they did with the buy now, pay later. He said it's not going to be meaningful in 2026, buy now, pay later, but if it continues to grow at this rate, it should start to be meaningful in 2027. Overall, it's what I said at the beginning, like more of the same. They're executing, they know what they have to do. Every time they grow at this pace, they become stronger. This is a flywheel business. Even if some people freak out, I think it's becoming more widely known that margins and take rates aren't the most important KPI. Now I'm seeing a lot less people panicking about it than I've seen like 4 or 5 quarters ago, but there are still that people that don't really understand the business and comment without knowing that that's not the most important thing, and it's a consequence of the business driving. So I think, like, I'm a happy shareholder. I'd love to see the stock green tomorrow, but if we continue to like go down even more, this is just an absurd valuation. And yeah, you can talk about compressing margins, which we already know it's a stupid argument. But you can also say it's a Latin American company, headquartered in Uruguay, so it doesn't deserve a premium. But I mean, it's not about deserving a premium. It's about deserving to be properly valued. It's growing at like, we don't know the revenue growth, but even if you assume like 35% gross profit growth or 30%, whatever, at the multiples at which it's trading right now, it's just too cheap to ignore. I don't think I mean, the market can always be irrational for longer than we think, but I think the trend is clear, and I'm happy with having. I feel like I say this every quarter, but Pedro Arnt is really a beast, man. He's one of my favorite managers, like from all of my holdings, to be honest.
Yeah, no, I agree. Plus, for those who don't know, the CFO was previously, I think, 2-3 years at Visa and 13 years at American Express. So definitely has a lot of experience when it comes to payments. I was less surprised with the comments on stablecoins. I think there is just a lot of hype and talks about stablecoin adoption, etc., etc. But at the end of the day, I think I've yet to be paid or pay anyone with stablecoins right now. It will come with time for sure when the big companies start to adopt that, the Visas, the Mastercards, etc., etc. I'm also not. I mean, now we got the message, of course, quite clearly. 2025 investment year, 2026 we are past the investment year, but we still have the lagging effect in the first half. So I'm not going to be surprised when the next quarter margins are hit yet again. The question then will be, okay, they told us the second half is going to see margin expansion, so we're going to exit 26 in a much better way. So okay, maybe right now the market is again in that waiting room of, okay, you told us this, let's now see, because we know that TPV is going to grow quite quickly. We know gross profit is growing, but growing slower than TPV. But then if you look at operating profit, which is a new metric that they gave us, it grows faster than gross profit. So that's even better. It's a company that's worth just over $3 billion, closing in on $4 billion, growing very fast. It's profitable. Yes, there are, again, it's emerging markets, so I understand the risk, but this is not new. Like when you look at a company and you see the risk, you cannot say the same thing quarter after quarter after quarter, especially not when the company continues to grow above 50% TPV, which for them, they've made it quite clear that this is their metric that they're going after. And he said it. It's not that we're not looking at earnings. It's not that we're not looking at free cash flow and all of that. We are looking at it. But yeah, it's like you said, I think we said it already a couple of times before. If Pedro did not become the CEO of this company, I don't think it would have been a company in our portfolio.
Yeah, and even even mentioned you can decrease margins, but the EPS is going to follow the same trajectory. Especially now with the buyback, will also help in that regard, and that's what ultimately will drive the share price. I'm sure the company can continue to compound at very healthy levels, even if not at these insane levels for like a long time. But I always, and again, I feel like I say this every quarter. I think I said the same in our call in the last quarter. I always go back to what Pedro said in an interview about his times in Mali, and like how the beauty of being exposed to emerging markets, because it's a risk, but it's also the opportunity here. That's why they're growing so fast, and they're going to continue growing so fast for many, many years. And it's exactly that. It's not at the beginning, Mercado Libre had some investors that were like, why the hell are you not growing 100 or 200% year over year if you're an emerging markets company? And what happened is that now Mercado Libre is the only company in the world that has grown for like 30 plus or 40 plus percent year over year for like 30 quarters,
28.
something like that. 28 quarters. And that's, I think Dlocal is really well positioned to do something like that, like to compound for 5, 10, 15 years at 30% per year. Average, obviously, we'll have much higher years like we had this year. But that level of opportunity based on the current multiples, based on even if you don't assume any operating leverage, but just on the healthy margins that they already have. But we know that we could even go higher in terms of margins, and now the investment year is over, so we should see at least stabilizing margins over time. It's impossible for the stock not to follow in the long term. This is not one of those hyped stocks that you're going to see doubling in like a month or something like that. I don't own it with those expectations, but it's one that I feel and it's weird to say this about a small cap, but as a mostly small caps investor, I feel like this is a good anchor for my portfolio, in the way that I don't really have to spend much time digging it into what's happening. It's always execution. Each quarter, the flywheel effect continues to take place. They're always announcing new partners. The existing merchants are just they just contribute enough for the company to continue on that compounding level. So it's a company that I sleep very well owning. I know that the price action sometimes it's stubborn and like frustrating for many investors, and I don't blame them, especially because we're all too spoiled by the market over the past years, and like it's not doubling this year, so a lot of people get mad. And the recent drawdown after all the great quarters we've seen, I understand the frustration, but that doesn't take me my sleep. I really, really, every quarter I'm a satisfied investor. At least since I'm a shareholder. Maybe the first or the second weren't as good as these past ones, but yeah, basically I'm happy with the quarter.
I would agree. I think especially now, like you said, like for the last couple of years, I would say we were very spoiled by the market. And now, yes, if you own Dlocal, it hasn't done much more recently. But if you're a long-term investor, if the business continues to grow and do exactly what it should be doing, you should be happy if you want to accumulate more and more. If you were looking for an quick exit, then okay, I know it sucks. It's not the best example, but as I said before, NVIDIA has been flat for 7 months straight now. Literally, you go back 7 months, it's at the same price it is today. How can that be? Well, how can that be? It happens. Not everything goes up every single year. Why are fintech companies so hated right now? Probably has to do with the just macro financial pressure. If rates do stay higher for longer, we have the private credit market that's maybe under pressure right now. Fears of stagflation are maybe rising. Yeah. So all of these names, are under pressure. And for now, most of these companies are doing still very well.
I feel like at some point we're reaching peak pessimism in fintech. Like so many companies that just Dlocal isn't really the case. Like, but some companies just report normal earnings, like not that good, but not bad at all, and they just get destroyed. So at some point this has to stop, like says the wishful investor.
I mean, in the meantime, we collect the dividend, so
yeah, at least now we have and they can get cheap shares for the buyback.
Yeah, we get a dividend, we get a $300 million buyback that they have to, there is a 1 year period that they can use it. So
yeah, it should be a good thing to support the stock because it's not that liquid and the free float is pretty small. So it could be a good support in the coming months.
Agreed. All right, everyone. Thank you all for joining. Appreciate that. Just because the markets are down, just because your earnings swings did not work out, doesn't mean it's the end of the world. We've seen that before. We're probably going to see it again. So best thing you can do is probably do nothing. That's always a good thing.
Touch some grass.
Yep. Maybe not now, it's a bit late, but tomorrow.
Yeah. I mean, for our American friends, still some time.
True. So if you're in the US, go touch some grass. All right, everyone. Thank you all for joining. See you all in the next one.